Welcome, everyone, and thank you for joining us. My name is Mary Gordon, and I'm the National Account Sales Manager here at The Standard. Our subject matter expert today is Rob Vadine. Rob is an Actuary Vice President here at The Standard in the defined benefit space. He has over 20 years of experience working with retirement plans and has done many presentations like this one to trade and industry groups. Rob actively works with our plan sponsors and fiduciaries across the country, helping their cash balance and defined benefit plans. He is an associate in the Society of Actuaries, enrolled actuary, and is a member of the American Academy of Actuaries. Welcome, Rob, and over to you.
Thank you, Mary. We're happy to be here with you today. Good afternoon. We're going to cover a different area for you than you may be used to. We're going to talk about cash balance plans, which is a great way to diversify your business. Those of you who are just getting into the retirement plan space might only be thinking about 401k plans and 403b plans. Cash balance plans are another great option for your business owners to defer some taxes and save some money and create some great wealth for retirement in the process. So we're going to talk primarily. We're going to try to take you through the whole lifetime of a cash balance plan, helping you understand what it requires to get one started, who are the best candidates, how they work, how to design them and administer them, how to invest for them, different strategies for different types of cash balance plans, and then managing through a hardship. We're seeing a pretty tough year this year that many companies weren't expecting. And so ultimately, the whole plan here is for a business owner to roll this all up and retire at some point. So how do you get these plans terminated at the end of the day? I'm going to try to cover all this material. This is typically an hour-long presentation. I'm going to do it in 30 minutes for you today. So we probably won't have time to answer questions live, but please do send those questions in, and Mary, with the help of Excel 401k, will gather all those questions up and make sure that all of your questions are answered by one of our consultants and one of our actuaries. Why should we even think about cash balance plans? These cash balance plans are growing in popularity. 33% of all the ERISA pension plans are cash balance. There's over $1 trillion in assets out there in these plans now, and it's growing every single year. This is a great way to save for retirement and reduce your current tax obligation. If these are set up properly, they're very predictable, really easy to understand for the employees, and they're portable. When I talk about ease of understandability and portability, if you know anything about a traditional defined benefit plan, those are pretty tough to understand. We're telling you as a participant, if you work here for 20 years and you earn this much money, we're going to apply some magic factor to it and you'll get $600 a month until you die. How long are you going to live? What is that $600 a month really worth? It's really difficult to understand how to plan for that. And your 401k plan, much easier to understand. You're looking at a pool of assets. I've got $100,000 in my 401k account. You know exactly what that's worth. It's $100,000. When you leave your employer, hopefully you're happy where you are. But as an employee, if you want to leave your employer, you can take your 401k with you. You can't take that traditional defined benefit plan with you unless it offers a payment form that is a lump sum payment. Cash balance plans allow this lump sum payment, so you actually can take it with you from employer to employer and not leave it behind. It looks just like a 401k plan to a participant. They've got a pile of money. It's defined as a balance, an account balance concept, just like your 401k. It has the added option of being able to take it as an annuity. So if you do want to convert it to that $600 a month in my previous example, you could take your pot of money and convert it to an annuity that pays you over your life. So the advantages of these are really the significant tax savings opportunities here. You've got a much higher contribution limit for yourself as an employer and for your employees. This is primarily an employer business owner strategy. it really increases your limit. If you just look at the example here, and I've got a better example that shows a number of different ages, but this bullet here, if you are a 55-year-old, you've got a $63,500 DC, defined contribution plan limit. That's the profit sharing and your 401k components. You throw in a cash balance plan, and that limit is all of a sudden over $200,000. Significant tax savings if you can defer $200,000 instead of just $63,500. The best candidates for these, and I've got a couple slides on this, business owners who are really interested in increasing their tax savings. Over age 50 is important because of the way these the discrimination rules work for pension plans. We need these owners to be a little bit older and have employees who are a little younger to take advantage of the leverage that is the time value of money when we test these things to make sure that all this money can actually be deferred. And we look for higher compensation for these owners. $280,000 is kind of the minimum. That's your threshold for the IRS pay limit. If you're not making enough money to defer a significant amount, obviously it's not going to make sense to put one of these in place. When we look at companies that might be good candidates for this, we're primarily looking at professional services companies, doctors, dentists, lawyers, financial advisors, auditing firms, accountants. These are companies that typically are able to weather the business cycle in its ups and downs. I'm seeing some doctor friends of mine, some dentist friends of mine this year who were closed. Their shops were closed for a couple months, and that's really abnormal.
Hello, it seems like we might be having some technical difficulty. Rob, are you there?
Okay.
Oh, perfect. Okay.
Back.
Thanks, everyone.
Apologies. My VPN must have restarted in a really untimely fashion here. But when we're looking at these professional services firms, we need these companies to have consistent cash flows. Typically, your doctors and dentists and lawyers, they have this cash flow year over year over year, and they are not counter-cyclical to the business cycle, but can weather the recessions that we see, because everyone needs to still go to the doctor. You're not going to have the elective procedures, maybe, but typically your doctors and dentists are going to have that income throughout the business cycle. You need some younger rank and file employees. I've got the age 35 here. This really is for non-discrimination testing. The game here from an actuarial perspective is to make sure that the benefits and the contributions coming into the plan don't discriminate in favor of the owners. There is a lot of leeway in these rules, but they require some age leverage to value the time value of money here. So we like to see no more than 10 to 15 employees per owner. Just makes it a little easier for that discrimination work to make sure that we can ensure that all the contributions are tax deductible. Mentioned the consistent profits year to year. You will have to, as an owner, contribute a little bit more to your employees' 401k and profit sharing plans. That a little bit more, though, should be more than offset by any tax savings that you'll see as a business owner for implementing one of these plans. So how do they work? This example here, it's just showing you how the cash balance account rolls forward. It looks almost identical to a 401k plan. You've got a beginning balance. You get earnings on that beginning balance, which is defined. It's a defined term called the interest credit. You get a contribution, just like you would to a 401k. That's called a pay credit in a cash balance plan. Any distributions or adjustments are made, and then you've got your ending balance, which is just the amount you started with, plus the earnings or the interest credit, plus any money that you put in. Typically, these are valued annually. We do have some plans that we work on that value them more frequently, some as frequently as monthly. When I consider these plans, the whole point here really is just to defer some taxes and save some tax money. It doesn't make a lot of sense from my perspective to make these complicated. Value them annually, make it simple. Anybody who leaves mid-year, we can do an adjustment calculation for each participant as they take off. An important key concept here is that these accounts are not funded by the participants explicitly. They are employer funded. So in your 401k plan, typically you would see a contribution coming in by the employee and potentially a match by the company. In these plans, there is no contribution coming in directly from the employee. It's all employer funded. The participants typically do not have individual control of their account. It's a pooled account that is managed. The investment strategy is managed by professionals, the advisor, not the participants. So the plan sponsor and the advisor are actually moving this money in an asset allocation methodology. And this last bullet is really important. This is a defined benefit plan. It's a hybrid defined benefit plan, a defined benefit plan that looks like a defined contribution plan. But because it's technically a defined benefit plan, the IRS's funding rules apply. So you do need an actuary to do an annual evaluation of the plan to determine the minimum required contribution to the plan. The actuary will also be, as part of that process, calculating the maximum tax deductible contribution for each owner of the plan. But there is an actuary required here for these plans. Getting into a little more detail about the components of your cash balance plan, the pay credit is the contribution. Like I mentioned earlier in that example, this is typically a percentage of pay. For some hourly folks, we have an engineering firm that has some blue collar workers working for them. They use a flat dollar amount rather than a percentage of compensation. But for the most part, we're looking at a percentage of compensation going in for your pay credit. Really important here. When we talk later about the business cycle and managing through a business hardship, you're typically required to work 1,000 hours in the plan year to get the pay credit. Like I mentioned earlier, pay credits can be credited monthly, quarterly, annually. Easiest if it's annual. It just makes everything easier. The discrimination testing, the actual evaluations, the ease for the understanding for the participants, everything's just easier to understand if it's just done once a year. The contribution formula for the owners and employees is determined as part of the planning process when you're designing the plan at the outset. This can be amended and may need to be amended in a business hardship situation or a recession in the business cycle if the cash flows aren't there to make the contributions. But the goal here really is to design a plan that you can sustain. It's conservative in nature from a contributions perspective based on your ability to generate cash flow in your business. Here's the slide I mentioned earlier. This is showing you at different ages the value of the cash balance plan deferral. You can see at age 55, this is the example from earlier, your 401k plus your profit sharing contribution is $63,500. That's the limit. You can throw another $207,900 in if your plan is designed correctly and you have the cash to do it to a cash balance plan. That puts your limit for your total retirement savings for the year at $271,000. That is a significant amount of money to not have to pay taxes on. If we look at the potential tax savings here, I know some of these employers aren't in states that have income tax, but we're running a potential tax savings here that shows combined federal and state income tax. At 55, you could save up to $114,000 in taxes by putting one of these plans in place. You can see as you get older, those limits go up. So really, really great strategy for your business owners that have additional cash that they'd like to defer and save toward retirement to put something in place and get this money in their pockets instead of in the government's pockets. Things we should consider as we're designing these things. Multiple owners can oftentimes disagree. It can be difficult to put a plan in place for a company that has 40 partners. Your partners may not all agree on what to contribute. Some of them might not want to contribute anything. The nice thing about a cash balance plan is they don't have to. You can have owners that decide they don't want to contribute anything to this plan, and they can write in a contribution of zero. Certain employees or employee groups can be excluded. As you're working with your TPA and your actuary, they can help you with all of these nuances in the code and the regulations that are thousands of pages long. We are able to be the expert for you. You don't have to be the expert on all this stuff. You just need to know when to tap into those experts, primarily your TPA and your actuary. Questions that you should be asking your owners: how much in a normal year of running your business do you think you'd like to contribute? And then think about the worst case scenario. As an actuary, I have a bent toward worst case scenario. I'm always thinking about the worst case scenario. How can things blow up and go horribly wrong? How much can you commit if you have a horrible year, if you have a down year, your worst year, and you're not able to make a change to the plan in time? These are questions that can guide the conversation about how to design the plan and should definitely be asked. Non-discrimination testing is incredibly complicated. I don't want to get deep into it here in this conversation just because of time, but it is your actuary, your TPA can help with this, and it's important to understand this as a business owner when you're setting up the plan. You don't have to understand it like the actuary does. You just have to understand that you will have to make some contribution to your rank and file employees to make this all work. You can't just put money in for the owners and run off into the sunset. You have to give something to the employees, but that something is going to be completely, in almost every case, overwhelmed by the tax savings. When we talk about the interest crediting rate, this is the earnings on the account balance. This is defined in the plan. You can use a number of different methods for this. A fixed rate of up to 6%. This is my favorite. It's the most simple. It's the easiest from a valuation perspective. It's the easiest from a non-discrimination perspective. It's easy to design from a legal perspective, and it accomplishes all of the goals here of putting money away on a tax-deferred basis. You could also use some sort of benchmark in the markets, treasury yields, high-quality corporate bond yields. You could use any sort of index to mark these interest credits. You could even use the actual rate of return on the plan assets now. There was some controversy about this in years past, but the IRS came out with some guidelines in the last few years that allow this now, and this one can be tricky for non-discrimination testing. Sometimes employers will want to put a collar around the actual rate of return so you don't see huge drops or huge increases in an account balance. If you think about the purpose of this plan, the purpose is to be able to contribute that $200,000 or whatever it is every single year. If you shoot the lights out on the investment return, you might be shooting yourself in the foot with regard to next year's contribution. So think about a conservative investment strategy and a conservative interest crediting rate strategy to allow you to keep putting money away year after year after year. When we think about the different interest crediting rate strategies, how should you be investing? As an advisor, how should you talk to your business owners about how to invest for these plans? If you think about the leverage in a defined benefit plan, if you have a fixed interest crediting rate, that means that, let's just use 5% as an example. Every single year, your cash balance account is going to move up with 5% interest. As interest rates in the market go up, nothing happens to that cash balance account. It still goes up at 5% regardless of what the market's doing. But when we value the liability for certain purposes, we use a market rate. So if the interest rate is going up and you think about these as a bond with coupons, that inverse relationship between the value of a bond and the interest rate is the same thing that applies to the valuation of a liability for a defined benefit plan. As interest rates go up, liability goes down. Opposite is true if interest rates go down. If interest rates in the marketplace go down, your cash balance account is still rolling forward at 5%, but your liability for some purposes goes up. So ultimately, at the end of the day, all we really care about is the cash balance account when we're paying out. But keep in mind, if you're sensitive to your accounting measurements, you might want to put some sort of investment strategy.
Hello, Rob. I think we lost you again. Oh, there you are. I think Rob has dropped off for a moment. I think he might be trying to connect in a minute. In the meantime, if there are any questions you have, I am monitoring the questions. Rob is back.
I'm back. Apologies for the connection issues here. When we're talking about this, what we really want for this, do I need to share this again?
Yeah, we're not seeing your presentation. Perfect.
So back
Thank
on
you.
this page, what we really want to see is a conservative investment strategy here that is tied somewhat to exogenous interest rates. Some money in a stable value or money market fund, high quality corporate bonds, strips, treasuries, these things, most of these things move and go up and down with market rates. So don't take a ton of risk here in the equity markets with your cash balance plan. These things really should be the owner's safe part of their investment, their total investment portfolio for their lives. When we talk about a floating interest credit strategy, the only difference here is the cash balance account floats as well. You still have those rates on the outside moving up and down, but as interest rates go up, your projected account balance grows. As they go up, your present value factors go down and your liability goes down. The impact here really is a little bit more volatility with the liability because of the way both the account balance now and the liability is moving. So in this case, you might consider, depending on the size of your plan, some interest rate derivatives to mitigate that volatility if that's important to the business owner. As we think about how this could actually work and play out for an organization, I've got an illustration here that shows a couple of owners and some employees. And we're attempting to illustrate the impact of the savings here. Your owners are earning about $600,000 Their plan compensation is limited to $280,000. They can contribute $25,000 to the 401k, $37,000 to the profit sharing. Owner one decides at age 60, she wants to put $250,000 away in the cash balance plan. The total contribution here is $312,000 for that owner. If you look at the tax savings using the same basis I showed previously, with the cash balance plan, there's a tax savings here of $131,000 as opposed to only $26,000 without the cash balance plan. If you look down at the employee total, the total amount contributed to the cash balance plan of $10,750 for the employees is completely overwhelmed by the tax savings for the owners. So just a nice little illustration here of what it might look like for a couple owners with some employees having to contribute a little bit to a cash balance plan, and how incredible the leverage on this tax savings is. I'm going to skip that one, and let's, in the interest of time, let's go to managing through a business hardship here, because we're in the middle of one, hopefully toward the end of it. But when you are in a plan like this, the contributions are required. Annual contributions are required. One thing you can do, and this is where that 1,000 hours requirement to earn the pay credit comes in. And if you are forecasting a very difficult year from a cash flow perspective, and you're worried as a business owner that you won't be able to make your contribution amount, you should consider freezing the pay credits. And this is an amendment to the plan to do this. Also, probably close the plan for the year to new entrants. This will limit significantly the amount of contribution that's required to the plan. There might still be a small one if the plan is underfunded for other reasons. Maybe the investment strategy doesn't tie perfectly to the liabilities, and you've got a small underfunded amount. But ultimately, this is a great strategy here if you realize it in time to get the plan contribution to a minimum for a year you're having a tough time. It does require an amendment to the plan, a legal amendment. There's a 15-day advance participant notice requirement for a small plan, 45 days for a large plan. So you need to get out in front of this as a business owner. You need to understand your clients' needs, their businesses, check in with them regularly, and understand early in their fiscal year what this might be looking like for them. Lastly, when we're looking at terminating a plan, when the owners retire, they want to sell the business, divest it, whatever they're thinking about. This is quite a process. Terminating a plan is not just paying out retirement benefits and calling it good. There are some organizations that are involved here, and this process can take some time. So getting out in front of it, again, is very important to understand your business owners, their timelines, their needs. It's not always going to be perfect. Sometimes things come up, but the better you can plan for these things and get your actuary and your TPA involved early, the better these will go and the smoother they will go. When you are terminating the plan, all the participants have to be made 100% vested, whether they've been there a year or 20 years. You have to provide advanced written notice to all the participants. You've got to file the plan termination with the PBGC, which is the Pension Benefit Guarantee Corporation, and acts as the insurance company for private pension plans. You may have to file the termination with the IRS as well to request what's called a favorable determination letter on the plan document itself. You can typically cash everybody out, but you do have to offer an annuity under the plan. If participants decide they don't want the lump sum value of their account, they want to take an annuity, you have to find an insurance company to place those annuities with. There are some insurance companies that specialize in small plan terminations. Your actuary should be able to help you with those placements, but it can cost more to place the annuity than it costs to cash somebody out, just because of the longer period of time that money is going to be paid out, the administrative burden of managing those records by the insurance company. They do charge a premium over and above the value of the lump sum typically. That can be about a 20% premium to the value of the lump sum in some cases. Ultimately, the whole point of this is to roll this up at some point. It's met the purpose the owners put it in place for, and the actuary, the TPA, the advisor, we all play a vital role here in these employers' lives and their businesses. So this is the end of the presentation. I went through this really fast. I usually take another 30 minutes to get through all this and go into a lot more detail, but we are here. Mary's going to get all the questions that were asked. We'll make sure to reach out to everyone who asked a question and get all those questions answered. Thank you very much for listening. Sorry for the technical difficulties. Fortunately, they were quick, and I was back up quickly.
Yes, thank you, Rob. Thanks everyone for attending today, and thank you, Advisor 2X, for this opportunity. Thank you.